Hi, this is Carl Buell with Navocate Business Sales and Acquisitions. It's 1 o'clock. I think we'll start at 12:01. I see a few people that just need to get into the audio portion here, but I think we can start. Thank you for joining us today. This is a Navocate Webit. The Webit promises cool content fast in 30 minutes and on your way, except for the Q&A. Our cool Webit mascot is a copyright of Navocate. Some general information today. Before we begin, all attendees are in listen-only mode. If you would like to ask any questions at any time during the event, you may type the question into the Q&A window on the right side of your screen. We will open the session for discussion at the end of the event if that's warranted and we have a discussion. We are also recording today's event. Your participation in the event represents your acknowledgement of the recording and your agreement to participate. Finally, this is a live event where nothing can go wrong. So with that, let's introduce ourselves. And Mr. Boaz,
Yep.
I have unmuted your microphone.
Hi, my name is Boaz, and Carl, who you just heard, is the founder of Navocate. He's been a Fortune 50 executive and in management position, entrepreneured his own companies, bought them, grew them, sold them. As an advertising executive out of Chicago, he was handling accounts like General Mills and McDonald's, and as a former Microsoft executive, he handled the Microsoft government affairs, which I'm sure you're all familiar with how much fun that can be, and did quite a bit of business development and M&A in that environment as well. Carl?
All right. Thank you, Boaz. And I would like to introduce Boaz Vinograda. Boaz is a former president and CEO of several technology and medical device companies. He has grown startups from zero to the range of $30 to $100 million in sales, and has participated in 3 IPO exits from the inside, 2 of those on the NASDAQ and 1 on the Swiss Stock Exchange. So we're very pleased to have Boaz as part of our team. A quick little brief sponsorship announcement. Our company is Navocate. That's a morpheme that combines the words navigation and advocate. Navocate provides business sales and acquisitions for privately held, entrepreneurially owned emerging companies with revenues up to about $25 million. We focus on the underserved market segment above business brokers and below the investment banks. We represent sellers, buyers, and owners who grow their companies through private equity relationships. Comments today reflect the opinion of management, do not represent official recommendations to you. Please consult your attorney or CPA before making any decisions. Your mileage may vary. And so now let's go through our agenda. Thank you, first of all, for everyone who joined us today. We know how valuable everybody's time is. We appreciate your interest in Navocate, and we appreciate you joining us. I wanted to mention quickly that we have participants from all over the United States today. So we'd like to welcome Newark, New Jersey, Cannon Falls, Minnesota. We have quite a few people in our backyard here in Florida, Boston, Colorado Springs, Morristown, New Jersey, Plano, Gig Harbor, Washington, one of my favorite places. I used to live in Seattle for about 18 years, and New York City. So with that, welcome all. Thank you again, and let's get into our agenda. We're going to talk about the 5 dumbest mistakes in selling a business. Of course, that's a very subjective call about what's dumb and what's dumbest, but here are our 5. Number 1 is not setting a realistic offer price. The second one is misunderstanding buyer liabilities in a stock sale. The third is not being ready when a buyer makes a legitimate offer. Fourth, don't change your boat midstream, and we'll talk about that, all of these actually in more detail and more specifically. And then our final point, which is what we call the world's biggest legal trap. So let's just jump right in. For those of you who remember the television series Dragnet, you know that they opened up with this introduction. The stories you are about to hear are true, only the names have been changed to protect the innocent. So we're going to give you some examples of some really dumb things we think that sellers have done along the way here. Let's talk about the first one, which is not selling for a realistic offer price. So when you're selling a business, the buyer isn't really buying a business. What they're really buying is the cash flow and, of course, also the asset value that is related to that business. A multiple factor is what is applied to the business valuation based on the cash flow, but also as an assessment of what the risks are. The risks are a function of the market, the competitors, the business model, the business cycle, and that business cycle is getting shorter and shorter. So many entrepreneurs, when they get to the point of trying to figure out what to offer their business for, take a do-it-yourself approach to valuation. And that ends up being a little bit jaded or skewed, obviously. What we find from our experience is that somebody who does a self-valuation either finds that their price is way too high or it's way too low. Very rarely is it in the right strike zone, and usually what we find is that it's way too high. So when you're looking at making a decision about a valuation, it's not what you think it should be or what you think your price is that you need to get out of it. You really need to look very closely at setting a realistic offer price. We're going to talk about that today here. One of the disadvantages, if you do a do-it-yourself valuation, is that you have to understand often the best prospects are the early prospects, and that works if you flip it around. Your early prospects are your best prospects. Supply can often meet demand quickly, and we define quickly as 6 months. If you're getting a lot of responses and good responses within 6 months, if you're not getting that strong bite in the first 6 months, it's an indication that things aren't positioned correctly or your offer price isn't set correctly. If the offer price is too high and too long, just like anything else, you may alienate your best prospects. When you come to market, the reason that first 6 months is so important is because your business now comes on the marketplace. There are people that are likely looking for a business like yours. So the scouts are out, their radar is on, they're looking for your type of business. They find you and engage. That's the easy part. And then if your prospects find and conclude that your price has nothing to do with reality, you, again, may have alienated your best prospects. And likely those prospects, very high degree of probability, I would say 98% plus, are never coming back to you because you have defined the business as being unrealistic. And so what happens is the business starts to sit as interest starts to stagnate, and now the business gets a stigma that there's something wrong with it. It's very difficult to recover from this. So a key point here is that selling a business is not like, for example, residential real estate, where you have a very nice house, you say, let's put it on the market. We think the value is $500,000. Let's put it on the market for $750,000. Of course, those days are gone. But people did that to find out if there was somebody who would come along and fall in love with the house. You never want to fall in love with the business. You do want to fall in love with the cash flow. But a business has to be priced realistically from the get-go if you're serious about selling it. So in this example, where the business sits in it and the interest stagnates and it's developed a stigma, what has happened here? You have tried to hoard all the toys. And Boaz, I don't know about you, but my mom always said not to grab all the dolls at one time. Did your mom give you that advice?
No, I never did.
All right. So, but the reason I think that's not such a funny joke is I watched a documentary recently about Jeff Dunham, who is the ventriloquist, who some of you may have seen. He is now playing to stadium-sized audiences. So playing with dolls can be profitable as well. Not for us, so let's move on here. We recommend, relative to setting a realistic offer price, that you get an independent valuation. And we have a video that we've done about that. We've done a webcast about that. It's called How to Value Your Business for a Timely Sale. And this is the shortcut link, http://navo.cat/, and you can see the rest there. We'll give you a second to copy that down, and if you participate in our survey, we will actually give you a copy of this slide deck, so you will be able to find it then. But getting an independent valuation is very important. In that video, we talk about 4 approaches to business valuation. And these are what we think are the 4 main approaches. First is an accredited appraiser. The second is business intermediaries. Third, do it online, a new category. And the fourth is do it yourself. I'm not going to go into that detail right now because I think that webcast was an hour long, but that video explains these 4 different options and what the advantages and disadvantages of each are. So getting a valuation and setting a realistic offer price is a key mistake of not doing that. The second is misunderstanding buyer liabilities in a stock sale. And this isn't a huge one, but it's one that's very important because in a stock sale, well, you have 2 types of sales. And by the way, we have quite a few CPAs and attorneys on, so a lot of people understand this, but for those of you who are business owners, let me just quickly say there are 2 basic types of sales, an asset sale and a stock sale. The key event after closing is that in an asset sale, generally speaking, you have a new entity, so the old entity sells, and then it goes to a new entity with a new buyer. That new entity then starts with a brand new set of its own liabilities. When you have a stock sale, generally speaking, not all the time, but usually you're selling stock in an existing entity, and that existing entity retains existing and previous liabilities. So that's important when you're selling to understand that, because you may be dealing with a buyer who understands that there is increased and inherent risk in a stock sale because the liabilities pass to an existing from the former owner through the existing entity and are retained as previous liabilities and continuing as existing liabilities. So that's something we find that buyers and sellers don't always understand, and it's important from the buyer side, but it's also important from a seller side to understand that a stock sale, while both asset and stock sales have advantages and disadvantages, one particular issue about a stock sale is that those liabilities are retained. And we're covering a lot of ground here, obviously, so we're not going to go into detail. We would recommend that you speak to your attorney and legal counsel about that to understand that thoroughly. The third point, now we're getting into some very interesting psychological issues, not being ready when when a buyer makes a legitimate offer. And for this part of the presentation, I'm going to turn it over to Mr. Vinogradov here, who recently went through an experience like this, and he'll tell you about it right now. Boaz?
So we had a business that was making about $10 million a year, and in this case, Navocate represented the buyer. Prospectus was done. The company looked very good on the prospectus side, several small divisions within it, a very detailed explanation about the competitive advantage and competitive landscape of the company, and some level of financials, but not very detailed one. Based on that, we went to see the asset and meet the company and had a buyer-seller meeting in which the intermediaries, the buyer and the seller, sat in the same room, and we talked about very many things. And at the end of the conversation, we set the expectations of what the price might be. The price, as often is the case, was a multiple of EBITDA. In this case, 4 to 5 times EBITDA represented somewhere between $3.5 to close to $4.5 million in value of the company. And we've cleared that the seller is willing to take some seller financing, whether it's a note or an earn-out. Obviously, the seller preferred a note, but the seller was ready to accept a price in that range and to accept a seller note, which, by the way, if you're taking a small business loan from any bank, seller has to retain some level of a note with the deal itself taking place. And so it's not unusual for something like this to happen. It took us about 5 days, and the buyer came back to the seller with a term sheet that made an offer for 4 times EBITDA and expected to give the seller or get a 20% seller note, paying 6% on that note for the 3 years of the note term. And obviously this is at the low end of the range, hoping to get some sort of a counter offer and meet somewhere in the middle, which is, depending on your experiences, oftentimes this is how things take place. 2, 3, 4 iterations, but this is how things usually happen. You don't want to offer the full price up front unless you feel that somebody else is going to come and steal that asset, which was not the case here. The first thing that happened is that the buyer did not even acknowledge reception, and literally...
Seller, you mean?
Yep, the seller did not acknowledge the offer and disappeared for 2 weeks. Even his intermediary was unable to get hold of him, and of course everybody is in an uncomfortable situation. By the time these 2 weeks were over, we obviously assessed that this was a seller that was not ready to sell the business, that everything was discussion, paperwork, opportunity to present his company in the best light, but he really emotionally never made it to the point that he accepted the fact that he's going to sell his business and lose the control over it. And when he resurfaced, he asked for $5 million, which was about 6 times EBITDA or close to it, and said that he will accept no financing. Namely, he wants a cash deal. That is literally a form of 2 actions, both of them saying, I'm killing the deal. If you walk into a deal with a set expectations that are not within the market, you have a chance. And I think in my career, it hasn't happened, but I've heard of people that had the case happen to them. Somebody came, was so excited, offered above the asking price, and took the company. Never happened to me and I'm 54 years old, and been doing M&As for 20 years. So I think it's quite rare, but it can happen. The more realistic game is meeting people in the middle, meet me halfway, shooting for a win-win type of a situation, and that is how most of the deals, certainly in the United States, despite my funny accent, certainly in the United States, that's how most deals are being done. So the seller that wasn't really interested in selling showed everybody who's boss and who makes the final decision over here, and with that comes an adrenaline rush that goes in on the seller's side, and the buyer doesn't even respond. The buyer usually disappears, and with him many others, because intermediaries are aware that the deal was on the table, and when the deal doesn't go through, something must be wrong somewhere. Whether it's the buyer or the seller, it's not really the issue. Carl?
Okay. Thanks, Boaz. I think the key point there, Boaz mentioned the importance of setting expectations. So when you're a buyer or if you're a seller in a deal and you're working with a buyer, you are, as you are going along the initial discussion, the negotiation process, you are constantly setting expectations. And so it's very important when you set expectations in a certain way to deliver on those expectations. For those of you who are service providers and professional providers, attorneys and CPAs, you know this, and accountants, financial advisors. If you're working with a customer who is selling a business, setting expectations along the way and adhering to those expectations is very important. So that really leads us to our next point, which is don't change your boat midstream. And our point here is it's not the boat. If you're a seller, don't change your mind midstream. These are all things that we've seen. I want to sell? No, I don't think I want to sell. That's obviously a huge one. I'll sell for $4 million. No, I changed my mind to $5 million. We just saw the perfect example of that. That's a hand grenade in the room. I'll provide some financing. Now as we get closer to negotiations, I want all cash. We just saw that as with the case history Boaz just spoke with. Yes, inventory is included. Now as I'm getting closer to closing, I want to charge extra for the inventory. By the way, there are many databases out there, and we subscribe to them, many of them, that indicate when industries customarily include the inventory and when the inventory is not included. More times than not, it's usually always included. I'll provide payroll reports. No, he's not going to get the payroll reports. I'll provide the merchant services report. No, he's not getting the merchant services report. Back and forth, on and on. These are all specific and all real examples. The point is back to the one of deciding upfront clearly what your strategy is, what your points are for negotiating, setting expectations clearly, and adhering to that. So that's our number 4. Now we'll get into number 5, the world's biggest legal trap. And I know we have several attorneys on the phone, and they are thinking, what's this guy going to say? What's the biggest legal trap? And what I say is probably going to make some of you laugh. And the world's biggest legal trap is called lying. And that may seem like an obvious and kind of an inappropriate thing to say as the 5th dumbest mistake, but actually we see a lot of this. And I think it's important to talk about how this comes about. In most instances, with most sellers, if you had a conversation with them and accused any one of them of not being truthful, they would all deny it. What we see is not so much people overtly lying, at least from their own perception. We see very strong entrepreneurs with very strong egos who get into a situation where they view the truth in a certain way, and it's not really reflective of reality. The key point here is, if you are a seller, you need to be crystal clear about what the facts are, and you need to adhere to those facts, and you need to be squeaky clean. And we would actually recommend that you document everything as you go along this process. He who has documentation wins, if push ever comes to shove. If you get through a deal where a seller is a very strong seller and a very strong ego and is pushing and shoving a little bit, then what happens is you get a very unhappy buyer on the other end, and it usually ends up, or often ends up, in a lawsuit, unfortunately. Again, for those of you who provide a service to your customers and clients, setting expectations, helping them stay true to the facts, and helping guide them through this process is an extremely valuable advice, or set of advice that you can provide to your clients. It's not very easy for a buyer or a seller to get through the process of buying or selling a business without good, strong advisors to help them and guide them along the way. So you really need a team, and some of our previous webcasts have discussed this point, the value of defining a team up front that's going to help take you through this process. So that's number 5. As we get to the Q&A here, before we get to the Q&A, all participants will receive Selling a Business Preparedness Evaluation Guide that we have developed for Navocate. In addition to that, we will send you a quick survey afterwards via SurveyMonkey. If you fill out that survey, we'll actually give you a copy of the PowerPoint here as well.